Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. A few weeks ago, we held the Thoughtful Money Fall Online Conference, which was a fantastic event. But the bonus video that all conference attendees received was a video from precious metals analyst Jeff Clark going over his top picks for precious metals mining stocks. Now, it was very well received at the time, but in the weeks following the conference, the precious metals went through a bit of a price correction, which was, to be honest, quite expected, given how far and fast that they had run up in the months before. Now that the precious metals are back in rally mode, Jeff and I, and quite frankly, a number of the people that watched the conference, thought it'd be a really good idea to share that video with the general public at large. So that's what you're going to see here. So enjoy.
Hi, everyone. This is Jeff Clark of the Pater Prospector newsletter at thegoldadvisor.com. Thank you so much for watching this video. This is your bonus video, as usual, from Adam Taggart's Thoughtful Money Fall Conference. So I'm glad to be joining back here. And, you know, a lot's been happening in the gold sector. We have a lot to talk about. I have what I think is a pretty exciting presentation and lots of good research to give you, lots of good picks. And so I want to get into it. But for those of you that don't know me, my dad was a gold prospector back in the day. He didn't work for a company, he worked on his own, had some successes. His biggest success was a beautiful 5-pound, roughly, piece of bright white quartz that had gold weaving throughout it. We estimated about 3.5 ounces. One piece. It was awesome. Anyway, I've worked for Doug Casey. I've worked for Mike Maloney. I've worked for other newsletters, other bullion dealers. Started thegoldadvisor.com in the middle of COVID, but it's been successful and we're having a lot of fun. We're doing really well. We'll talk more about that later, but I just wanted to give you a background on me for those that don't know me. Okay, as usual, I've got a PowerPoint presentation here. I'm going to share it with you. And I think you should be able to see that there. So this is what we're going to talk about, the type of junior stock you must buy right now. And there's very specific types of junior stocks that are doing well right now, others that quite aren't. So we're going to focus on the ones that are doing well, but there's one in particular you may not be aware of that is doing really well. I have my favorite stocks I'm going to share with you in 4 different categories, plus how to prepare for a correction, because I do think that's coming. This is the current precious metals bull market that we're going to talk about. And here are the specifics, what a gold bull market looks like, why I remain long, why there's a valuation disconnect. I'm going to show that to you. Correction is incoming. The strategy on how to handle the current environment. There's no magic formula, but I have some specific things I do to handle this specific type of environment that we're in right now. We're going to talk about the bifurcation in mining stocks. I have some interesting things to show you there. The 3 types of stocks getting rewarded right now, and one you got to buy right now. And again, my favorite stocks in 4 different categories. So let's jump in. Here we go. This is what a bull market looks like. You can see this is updated through October 10th. Gold has almost doubled. GDX has almost tripled. And GDXJ is up 220%. These figures are actually already outdated. They're actually up higher since. But anyway, we have the exact ingredients of what you look for in a confirmed bull market. GDXJ is outperforming GDX, and GDX is outperforming gold. Now, before I bring up my next slide, I want to ask you a question. What do you think is the top performing major asset class worldwide year to date? Do you think it's gold? Do you think it's Bitcoin? Do you think it's NASDAQ with all the AI stuff going on? If you guessed any of those, ladies and gentlemen, you are wrong. The top performing asset class year to date is gold stocks. Look at that. GDX up 123% year to date. And by the way, look at the top 5 performing asset classes year to date. They're all in the precious metals sector. Gold stocks, platinum, silver, palladium, gold, all of them are outperforming all major stock indexes worldwide, including the Nasdaq. They're outperforming Bitcoin. They're outperforming obviously the Nasdaq, real estate, commodities, and then you can see at the bottom there just how poorly oil and the US dollar have done year to date. Okay, so let's get into some more things here. Uh, Big investors are going big. That's exactly what is happening. In the first bullet point there, you can see gold stocks as a group raised $6.7 billion in Q3. It's the highest quarterly record on total on record. 6.7 billion in one quarter, the highest amount we've ever seen. And if you've been investing in the sector, you've probably noticed that many companies have been able to not only successfully raise, but raise enormous amounts. The company that was raising $1 and $2 million a year ago is now raising 5 million. The one that was raising 5 million a year ago is raising 10, 12, 15 million. We've seen some very big financings. What that means is these are usually investors that come from fund managers, institutions, things like that, the bigger investors. So they have been getting excited all year long about the sector and have been investing big amounts of money year to date. So that's something to be aware of. The second bullet point, you may not be aware of this. Q3 for gold was the largest quarterly gain on record. That's also true for silver. It was its biggest quarterly gain ever. Bank of America named gold miners its number one investment theme for this year, 2025, even ahead of AI. And it just raised its gold price forecast for to $5,000 for 2026. Now, I know it's Bank of America, and sometimes we get a little contrarian when we see some mainstream coming in, but this does mean they're going to be investing in the sector. Okay, all that said, obviously we want to know, is it time for a break? Because, and this is a fair question to ask, because look at this gold chart. This is a 1 year gold chart. The red line is the 200-day moving average. The blue line is the 50-day moving average. The green line is the 20-day moving average. And as of, you can see the date there in the top right, as of October 14th through that date, gold is outrunning all its moving averages. So it's a fair question to ask, is it time for a break? Let's talk about that. First of all, I'm moving my picture away. I don't know if it's in your way or not, but the current bull run is still not equaling other bull runs that gold has had. This is from the World Gold Council. You can see gold hit a milestone, but the fundamentals suggest we're still in the early innings. And that's true fundamentals, but it's also true technically. The gold line is the gold run to date as they measure it, and you can see it falls short of all other gold bull runs in terms of duration, and it's underperforming two out of the three other bull runs. In my opinion, I think there are others in there. We'll talk about that in a minute, but you can see it's far short of what happened in 1979, 1980. And yes, gold is overbought, but in terms of how far it can go, ultimately, it is not matched the run from 2011 yet, not matched the gains, and it's obviously not matched the gains from 1979, 1980. This is a very good chart, I think, from the uh, World Gold Council. The gold price, as you and I talk, is technically overbought. Any measure you look at it, gold is overbought. But in the big picture, the metal is still underowned. Again, this is from the World Gold Council, which shows percentage of holdings of private investors and also central banks. You can see how high that was back in 1980, 60%, and you can see where we are today between 15 and 20%. So again, the price is overbought, but the metal is underowned. So I think it's good to keep that in mind. Okay, what about gold stocks themselves? Well, this chart is all of the big gains we've had at different times since way back in the 1970s versus the current. So the first bar on the left there is our current bull run. Look at that. And compare that to all the other green bars. The 1979, 1980 is the first green bar. The next one there is the Hemlow rally. Look at that, over 4,000% for juniors. Mid 90s bull market, look at that. The 2001 to 2008, what I call the silent bull market, over 1,500%. The big rebound after the '08 crash, 845%. And then I have two smaller ones there to the right. I put them in because they were big gains, but in a very short period of time. The first one there in 2016, 321% gain in 7 months. That, our current bull run has not done that. And then the COVID rebound, 400%, that was also in about 6, 7 months. So in terms of gains of our stocks, we're far short of almost all historical big bull market runs. Here's some more evidence. This is the gold stock ratio to gold, the HUI, the gold stock index, and its ratio to the gold price. You can see the high mark there, you can see the low, and then look where our current ratio is. So a lot of people are nervous, like, oh, gold stocks are outrunning gold here. Is it time to sell or step aside or whatever? Well, you can see there on the far right, you can see the little blip up, a little line moving up. That is gold stocks recently outperforming gold. Yes, they have. But in the big picture, it's far short of where they've been before relative to the gold price. So there's a lot of upside left in gold stocks relative to the gold price. And here you go with the gold price to the NASDAQ. Um, the NASDAQ has been kind of weak, but it's been hot at times because of AI and things like that. And despite the gold price rising, it is still not far off its lows from back in 2021. So there's still a lot of room for the gold price itself to move up relative to the Nasdaq. And this chart is also true, by the way, for the S&P and Dow and things like that, but it's more dramatic with the Nasdaq. So you can see there's a lot of room to move for the gold price relative to common stocks. And by the way, we're still at a valuation disconnect despite the big move up in gold and gold stocks. Read along with me here. As of October 8th, GDX was trading at over 15 times earnings estimates for 2026. That's about the 5-year average, but it was 22 times in 2023, just 2 years ago. Also, GDX was trading at a multiple that's 33% below the S&P 500's PE ratio. The average discount is about 23%. Gold stocks are normally undervalued relative to the big stock market. But you can see we're even below what the average discount is for gold stocks. So there is still room for the valuation to catch up for gold stocks. So the bottom line for me is the bull market is not over. There's just too many risks and vulnerabilities out there in the system, all the systems basically, for gold to still move up. I list some of them there. If gold moves up, gold stocks are likely to follow. That's a theme we have in Pater. That's how you know, or my gold stock's going to move up. Well, if gold's moving up, usually gold stocks will move with it. Now, all that said, all that said, we're still going to have a correction and we need to be prepared for it. So I have some good data on this I want to share with you. So I've shown this chart before, but it's basically all the major corrections in the gold price back in the last bull market, 2001 to 2011. And you can see these are all the ones over 6%. There were 20 of them in 10 years, 10 and a half years. That's two a year. That's a lot. We've not seen that yet. You can see the average there on the far right, 12%. If you take out the '08 crash, it would still be 11%. We even had big corrections in the mania. The only mania we've really had, we're maybe in a mini mania now, but nothing like 1979, 1980. And during that time, there were, you can count them there were seven corrections over 6% in basically a 13-month period of time. And you can see there the average, still 10%. So even in a mania, we have to expect, at least historically, that there are going to be multiple and sometimes big corrections. And here you go. So far, ours have been small. So this chart was updated about a week ago. You can see I measured all the corrections over 4%. There's not many of them. The biggest was 7.6%. That's not even the average of what we've seen in past bull markets. So here's an interesting chart. Basically, I'm comparing our current corrections to the past ones. So the first red bar there on the left, that's the 78, 79, the mania correction, the average. The next bar is 2001 to 2011, the average. And then the rest of the red bars are the corrections we've had year to date. And you can see none of them even come close to being what the average was before. So there's some, insights here. First of all, we should expect a correction. We can expect multiple corrections. They may be big, but does it mean that the bull market is over if we get a 12% correction? No. So I think it's important to talk about how to handle this current environment because we've had a big run in gold. We've had even bigger runs in many gold stocks, not all, but many. So we have to be prepared. We have to kind of position ourselves appropriately for this market and be prepared for whatever may come. And I term it like this: it's positioning versus predicting. I don't spend a lot of time predicting. It's way too easy to be wrong. You'll be wrong, 90% of the time or whatever. So instead of trying to predict what's going to happen, try to focus on positioning yourself for the current environment. For me, this is what that means, and I hope you find this useful as well. First of all, you hold on to the best of best. It doesn't mean they won't correct when we get a correction; they will. But the stronger the company, the bigger the catalysts that are ahead, the bigger the growth that is ahead, the more likely a discovery that's ahead. That may be a company you want to hold on to more than sell or even take profits. But my second point there, you do want to take profits from your biggest gainers. So what you hate to see is you're up 500% on a stock and all of a sudden you're back to 50% up because of a big correction. So if you have big gainers, it only makes sense to take at least your original investment off the table. Build cash. You need to have cash. If I could double the amount of cash you have in your portfolio right now, how would that make you feel? You would probably feel more empowered and have more ability to handle any type of correction, even a big one, if your cash level is high. It doesn't mean you're selling all your stocks, it means you're building cash. If you don't have a lot of cash, to me, that is a signal that you should more likely take profits than maybe someone who has a big cash pile. So think about that. If you don't have a lot of cash, I would encourage you to consider taking more profits. Should you sell everything and buy back? No, absolutely not. That is not the way to go. Here's one example. Snowline Gold it's actually 31x for us now. 31x, 3,100% gain since I very first recommended it publicly. And it did that, by the way, during COVID, during a stock market crash, during a recession, and most importantly, during a bear market in mining stocks. So there you go. Now, maybe they're the exception and not the rule, but there are companies out there that are going to do similar things in this bull market. If you sell everything, you're going to have a problem of knowing when to buy back in. That's the issue. So I would encourage you not to do that. Should you buy a hot stock now, a stock that's really running hot? No. Yes, we may be in the start of a little mini mania here. but I would not chase something, especially something that's up 500%. You got to be real careful. And if you do that, you need to have your finger on the sell signal to, take profits if you get them right away, or to sell if it's just not working out. It's already run too much. That's the other problem with stocks that are up 500% or more. How much more are they going to run? Well, they'll run if gold stays hot, but they're going to be easy to correct. They might be the bigger corrections in those stocks than otherwise. What if there's a stock you really want? Jeff, I really like this stock, but it got away from me. Well, what I do is put it on my watch list and I watch for a big pullback for my first entry point. And that's one way to handle this. Let's say it's up 500%, but you really like it, but it pulls back, 25%. I might take a first tranche bite right then. Not my full position, but maybe just the first tranche and leave a tranche in case it falls any more than that. But look for a significant, meaningful pullback before you enter and buy a first tranche. Keep in mind, tax loss selling is ahead. However, this year there may not be a whole lot of that. There will be some, definitely, as I'm going to show you in the next chart here. But just be aware we could see some tax loss selling, and that could be an opportunity for some stocks on your watch list. In the meantime, enjoy the run. If you're invested, enjoy it. This is why we invest, is for this time right now. Okay, now switching gears, I want to talk about something else. I want to start to really dive into mining stocks themselves. Um, First of all, this is some of the stocks from my portfolio. And I noticed as I was preparing my last presentation that in my portfolio, I have a whole bunch of stocks that are doing really well. Hopefully, you do too. Those are the ones in the green. But I also have stocks that they're just not performing at all. And not only are they not rising, some are actually falling in this environment. So what the heck is going on? So there you go. I'm leaving the names off for obvious reasons, but you can see I have a lot of stocks that are down big and I have a lot of stocks that are up big. So why the bifurcation? Why the dichotomy? Well, there are three factors. There are three types of stocks that are getting rewarded right now, and that's the ones in the green. So let's talk about those three types of stocks, and these are the ones we want to focus on. First of all, discovery. If you make a discovery, if a company makes a discovery, their stock is going to get rewarded. I think everyone knows this. Even in a bear market, the in this chart, this is again from our portfolios. The first two there, the orange ones are copper ones. The next ones are gold ones. The last four are silver ones. These are all in our portfolio. All these companies have made some type of discovery and are getting rewarded for it. Their stocks are getting rewarded for it. So if you can focus on companies that are more likely to make a discovery than not, that could be a potential reward. Okay, what's the second type of stock getting rewarded right now? It's new producers, new production. So these again are stocks in our portfolios. The green ones are is the stock performance of those companies from 1 year before they started production to present. And you can see the gains there. So the market is really rewarding companies that are starting production now. The gold ones are ones that have declared a construction decision but are not in production yet. Now, Erdene, there, the first one, it just declared production since I made this chart. They're up even more since then. They're doing very well. But you can see the gains there from these companies. Once they make a construction decision, they enter that sweet spot, that pre-production stage that we like so much, that I like so much anyway. You can see how these have done. All right, ladies and gentlemen, what is the third type of stock that's getting rewarded right now? I just did another presentation at a conference. If you watch that, you know what it is, but it's an important one. And this is the category you must buy right now. It is new names. It's new companies that are just starting out and attract excitement from the market. Rob McEwen, David Garofalo, both mining veterans, legends in our industry, they both said the smaller, newer names offer the highest potential returns. This is bore out by history. I think it's true that part of our portfolio, not all of it, needs to focus on newer stocks. And it can't just be any name like I say there. They still have to pass the 6 P's in the book, okay? They still have to meet the criteria. Not every new name is going to do well. It has to be something that is meets all of our criteria and can attract attention from the market. Okay, here we go. So I have some stock picks in every one of these categories. So let's jump into that. This is the most exciting part, right? Okay, here's some discovery picks that I really like, or potential discovery picks, as I say. Okay, first is Golden Cross Resources. This is also a new name, by the way. Not a lot of people were aware of this when we first recommended it. But it's an Australian gold producer with a team that's generated big gains in the past. They're drilling a project right next door to Southern Cross, which is like 1.5 billion now market cap. Assays are pending. It's an overweight position for me. In this particular case, this company has similar geological signatures as Southern Cross right next door that made the big discovery, and yet Golden Cross's uh, they've identified more geological targets than what Southern Cross has. So this is a good speculation. This is what we look for. No guarantees, but it's what we look for. Pardon me. The next name is Stallion Uranium. Again, this is also a new name. At the conference I was at, I asked the audience, how many of you heard of this stock? And like two people raised their hands. I love that. That's what we look for, right? Is brand new names that haven't attracted a lot of attention yet, because when they do, that's when they can really run. Excuse me. This is the best opportunity for the discovery in the Athabasca. That's a question, by the way, but it's possible that this statement is true because they've got a new team in place that's made several uranium discoveries before, and just like Golden Cross, the geological signature of its flagship project is actually bigger than the Arrow discovery that was made nearby. Arrow is, excuse me, the big discovery with NextGen, big discovery. The stock has done extremely well. They have Stallion uranium has the same geological signature as that. A whopping 45% of the stock is owned by insiders. I made an overweight investment in a recent private placement, so that shows you what I think about the opportunity. Okay, here's some pre-producer picks. We like this stage because why? Once they declare a construction decision, from then up to the beginning of production, historically there's been a 90% chance of a 90% return in 18 months. Now, right now, that return is much bigger. Some of these have run. Rio 2 is run, but you can probably buy it on pullbacks. They have the Phoenix Gold Project in Chile. It is one of the largest undeveloped gold projects in the Americas. First pour is in January. So that is typically when we might look to take profits. Stocks are running real hot right now. If they're still running hot in January, you might get a bigger return. But again, you can see there it's up 240% year to date, but it'll probably be higher by January. Just be careful. This is one that's already up a lot. So if you buy it, uh, watch the news releases, and we cover this in Paid Prospector if you'd like to subscribe. We'll be making a formal recommendation once they declare a construction decision. First Nordic Metals, they just bought Mawson, Finland. So the combination of these two companies could eventually produce over 250,000 ounces of gold per year. That would obviously be very attractive to a major if some major wants to take them out. They are aggressively drilling right now. They're de-risking both projects. They have a new CEO in place. They're getting very aggressive. I like this company a lot. They're basically exploring an underexplored territory. Venom Capital Markets has a 1 year price target of $1.55 Canadian. Yesterday it was trading at 49 cents. So they're saying this stock could triple over the next year, given what could happen with the company. It is true that it is trading at a considerable discount to other gold developers, and this is a stock I'm overweight. Again, we cover all these in Pay Dirt Prospector if you'd like to know what we're doing and when. Okay, now I have another category here before we get to the new picks, because this is an important category. Um, it's resource builders, I call them. And these are companies that have 1 million ounces or whatever, and yet they're drilling a project that shows potential for 2 or 3 or 4 or 5 or whatever. And the first one here is Dryden Gold. Um, I asked the question, could this be the next Red Lake Gold District? Not just one little deposit, but multiple deposits. That's the potential that's showing here because it has striking similarity to the nearby Red Lake gold mine. And the president of Dryden Gold worked there. So this is someone who would know if Dryden Gold has this potential. She thinks it does. Look at this. Investors include Centerra Gold, Alamos Gold, Rob McEwen, Eric Sprott, Bob Quartermain, and multiple funds, along with Jeff Clark. So I did invest in a private placement, so I an overweight position. So I like this a lot. And again, as the resource is built bigger, significantly bigger, not 10% or 20%, that's going to attract more attention to it and more demand for the stock. Getcha Gold. How many of you have heard of Getcha Gold? This is a totally off the radar pick. No analysts really even cover it yet. There's like two of us newsletter writers that cover it, and that's it. But they've already got a 2.3 million ounce gold resource in Nevada. They're drilling right now to expand it. Assays are pending. There is a large, valuation gap between it and its after-tax NPV, net present value. Meaning that this is still offers a great entry point. If you're looking for stocks that haven't run up a lot, that haven't quadrupled or whatever, here's one that has not done that, and yet is a nice builder of a resource that's going to almost surely get bigger. Good hold there. Homeland Uranium. Uranium stocks are really moving. Homeland Uranium is also a new pick. Again, I asked people at the conference how many have heard of Homeland, and most had not. That's because they just acquired, well, it's like in the spring, a historic 35 million pound resource in Colorado. It has some vanadium, but this team is built things before. And this, what they're doing right now is trying to confirm and then add to that existing resource. And like I say, there, this team in place right now, boy, if you look at their website, this is a top-notch team. They've attracted some of the top people in the uranium sector. They've done what Homeland Uranium is trying to do. They've done that before. Stock has doubled year to date, so only buying pullbacks. I am overweight the stock. And here's some more new names. We've had some there, but here's some more of them. So I really like this company, Pacific Silver. It's run by CEO Todd Anthony, who I know very well. But this is a brand new silver explorer in Mexico. They're well cashed up. They're aggressively drilling an underexplored project in a prolific gold silver belt in Mexico. There's assays pending. But look at this. Investors include First Majestic, Vizsla Silver, Silvercorp Metals, Eric Sprott, and yours truly. But seriously, it's one of my biggest investments that I've made year to date in the sector. So that tells you what I think of the potential here. And obviously, a lot of other silver companies want to be in on this name. So I am told that the assays probably won't be till early December. So they're drilling right now in phase one. They'll probably do a phase two and then beginning in Q1. So there's going to be a lot of news flow, but watch for an early Christmas present, hopefully, from Pacifica Silver. A2 Gold, here's another one that's an overweight investment for me. They have a 1.4 million ounce gold resource in Nevada, but it's likely on its way to 3 million ounces because they've only tested 18% of their targets. They're drilling 20,000 meters a year for the next 2 to 3 years, maybe more. They're drilling right now. Assays are pending. There's also going to be a big resource update, which could be significant because, as I say there, the last one was done at $1,700 gold. So the resource is going to be very meaningful. Let's put it that way. They just did a recent financing and included Kinross. Kinross has actually invested multiple times with them, and they've put some of their technical people on the team. So Kinross Gold really believes in the possibilities here at A2 Gold. Eric Sprott has also invested. I invested an overweight position in that private placement, and it was because of one of the directors that got involved. You can read it in a write-up in Pater Prospector, but he's created serious shareholder value with the past few companies that he's been involved in. I followed him right into this and made an overweight position. So there you go. We do cover those both in Pater Prospector as well. Okay, so there you go. Like I say there, I want to strike Patered in this bull market. Um, I've been investing very aggressively. I will say that here in 2025. There will probably be another round of financings here before the year is over. I will probably be investing in some of those. We do have a resource advisor premium letter. If you are a high net worth investor, you can check that out on the website. We pass all of those private placements along to you with our recommendations. We have the free letter, Gold Advisor. We also have a free Silver Advisor letter. Pater, the book there is on the right. You can get it on Amazon. You can also read a PDF on our website too. It's not expensive. But a lot of my focus is at the Pater Prospector there, the logo on the bottom. This is basically early stage, higher risk, higher potential plays that are sometimes off the radar. They are new names. We will have more new picks here before the end of the year, but I've had 5 in the last 3 months. So most of those actually are still within a buy range. They have not run away yet. So we have very specific guidance in Pater Prospector. The newsletter is doing well. So if you're not a subscriber, I hope to see you. And there you go. So thank you, ladies and gentlemen. I hope this has been useful for you and you can apply it to your career as a mining stock investor. So thanks, everyone.
Pretty obvious that you're going to have a Fed coin. I think it's going to go to gold. It's going to drive the price really, really high. And gold's going to be one of these things that has a lot of value and it's really hard to sell. And people say, well, how is that even possible? Let's do a hypothetical scenario here. What if we saw a gold price much higher, like 5,000, eventually 10,000? That might go higher. And what you're going to see later is the reason it's going higher is because people are starting to move into it to protect themselves. Slowly bought some silver. I got a lot of silver. So now silver's like over $40. I got to go find all the silver. I can't find it all. So, and I've tried to find it all, and I look forward to selling it at some point, not right away, but I do think that it's going to go up over 50, and then people might start paying attention at that point.
Gold prices might rise rapidly to $5,000 or $10,000 if the United States eventually introduces a Fed coin, a closed-loop digital currency system. However, because the gold is not part of the official system, selling it could result in high excise taxes. Some analysis points to silver breaking its decade-long resistance, and possibly moving to higher levels $50 or more if certain large investor flows occur. Tucker points out that long-term holders may still profit when prices rise beyond $50 and probably higher. Stablecoins are now subject to more stringent regulations, including backing, audits, and supervision, after the Genius Act was passed in the United States in July 2025. This increases their credibility as competitors in the digital payments system and may lead to a wider acceptance of digital currency systems modeled after central banks. Known for his opinions on gold, silver, and the future of money, E.B. Tucker is a Resource Company board member, author, and investor. He points out that a Fedcoin, a digital currency based on a closed-loop blockchain and under central control, is ushering in a period of more stringent monetary regulation. Major asset manager Amundi has warned that, given its increasing use, stablecoin regulation may disrupt international payment flows and monetary sovereignty. Gold may rise to $5,000 or even $10,000 under such a regime as people race to buy it for protection, but because it is not part of the digital system, selling it could result in high taxes. As a sign of regulatory reform, Fed Governor Michelle Bowman has called on authorities to be less wary of new technologies and more proactive in regulating blockchain and cryptocurrency. E.B. Tucker believes this shift would make gold valuable but hard to trade. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
We're walking into this system where there's going to be increasing control. And right now you have a chance to play these hope things that are going on. And you should do that while understanding that you're pretty doomed. Well, what does that mean? All right, well, you look at this, all this metal here. I mean, gold has done even better, right? I mean, like at some point I just switched to buying only gold because you would need like an armored warehouse to keep all the silver in. But these are things that are going to run, and then at some point they're going to be untradeable. And the gold prices, call it like 25 trillion right now. That's if you take all the gold in the world and you put a price on it. That might go higher. And what you're going to see later is the reason it's going higher is because people are starting to move into it to protect themselves. Protect themselves from what? Well, it's pretty obvious that you're going to have a Fed coin. I wrote the term Fed coin in 2000, I think 15 or something. It was way too early. Okay, that's the other problem with writing books and reports. It's a huge mistake because people, it's nonfiction writing. You should really write fiction if you want to be a writer. It's much easier to hide behind that. But I put the term Fed coin out because there'll be a closed loop blockchain. And what's going to happen is there'll be no counterfeiting, there'll be no tax evasion, and there'll be nowhere to hide if you run afoul of the monetary regime. And what's that going to do to gold? Well, I don't know, but I'll tell you what I think it's going to do to gold is going to drive the price really, really high. And gold's going to be one of these things that has a lot of value and it's really hard to sell. And people say, well, how is that even possible? Let's do a hypothetical scenario here. What if we saw a gold price much higher, like 5,000, eventually 10,000? You might end up in a scenario where if you try to sell that gold, there's this massive excise tax, meaning the gold is sort of like outside of this blockchain system that we're in. Now, to be really clear, blockchain doesn't mean Bitcoin. Blockchain means that the Fed or some new version of the Fed would because you're going to expose the Fed for what it is and have a new, much worse Fed someday. And this would be like a closed loop blockchain. So what's interesting about Bitcoin is you have this like distributed ledger. So you would just have like one ledger, with Fedcoin, and it would be like centrally controlled Watson computer that would monitor every single serial number on every single Fed coin as it moved around. It'd be infinitely controllable. And then if you tried to sell the gold, you would be bringing it back into the Fed coin system, which would expose you to whatever tax rate you want. I mean, there might be like this, okay, you could sell the gold for this period at a fixed price, bring it back into the system. Does this sound familiar? Do you remember when this happened in the 1930s? There's some eerie similarities, like a sort of like a modern day computerized FDR scenario. Okay. Yeah. And so I think when people start seeing this, they start seeing, wow, I mean, this is possible. Now, here's what blows my mind is that then they say, how can I profit from this? And I'm thinking, these capitalists, man, Lenin had it right. These capitalists will be like, they're going to hang me. Is there a way I can make some money off the rope? Do you get what I'm saying? It's like, first step is you just need to see things you just need to see the bigger picture. I mean, you don't have to go profiting from every sort of thing that's going to happen. But
E.B. Tucker emphasizes that the demand for Fedcoin would be a response to attempts by individuals to conceal riches outside of the system, particularly in gold, rather than a result of an automatic tax deadline. Authorities may then impose severe penalties after providing a brief opportunity to legalize assets, much like FDR's gold policy but in digital form. This illustrates a larger reality. society is fixated on money and frequently pursues it unbalancedly. The lesson is to embrace change as it comes, see the system as a game, and concentrate on living life to the fullest rather than fighting against it. Although silver trails behind gold, Tucker points out that long-term holders may still profit when prices rise beyond $40 and probably higher. Let's review the interview.
I think it's not preordained. I think the issue would happen as a reaction to people trying to avoid cooperating with FedCoin. That's what would trigger it. So it's not like they say, on this date, we're going to have this excise tax. I think if people begin hiding, trying to preserve and hide and operate outside of the FedCoin regime, then that's when you would say, okay, we have a window of opportunity for you to get legal with your gold. And if you don't get legal with your gold, you're going to be subject to like a 90% excise tax. And also like all these, different ways that you can be punished because you're naughty school children, with having your gold. We told you that's only for governments. It's only for, foreign governments, not you. Okay. So that's the type of messaging. Just see the messaging. Like I remember as a kid, when we learned about algebra, I was like, what's the point of algebra? And, my father was really smart. He was like, you got to learn how the equation works. And then you're going to see that lots of parts of life are the same equation. You'd be able to solve things in life. I didn't really know what that meant, but it turns out, he was right. So like you see that you kind of see this process. Like what's the equation of FDR? It's easy when you go back and look because everybody, that was around then as an adult is dead now. Maybe there's some people that are old that were kids then, but see the equation and forget about the emotion. And then you look at the modern scenario, the digital version of that, and you say, wow, okay, I see how people hiding in gold would make it harder for FedCoin to take effect and be a control mechanism. It's going to control your whole life, okay? So everybody in the US is obsessed with money. And they're obsessed with money, and they hoard money. If you notice, people, they don't have enough money. Even people that have a lot of money, they don't quite have enough. Like the Morgan Stanley guy that I use is like, you should not stop working. Because the Tucker letter is like something I do because I love it, right? So that guy says you should be working more. Why should I be working? Well, you could have more money. Well, what would I do with more money? Eventually, I'd do something I enjoy. It doesn't make any sense. People's thinking is broken. And so you have a society that's totally obsessed with profit. I'm not going to say it's greedy because I don't think greed is bad. I also don't think money is bad. It's just that people are out of balance and they do something compulsively. And so when you back up a little bit and you see that this is where things are headed, then your job becomes different. Your job becomes to live now, to keep playing the game, but to know that it's a game and to see where it's going and to not be afraid of that because there's no stopping where it's going. And the world definitely keeps going. And you can survive and thrive through change. 1935 is not when the world stopped. It got infinitely more exciting, and it's going to get more exciting from here. You got to go along with it. You got to flow with it, but you can have more fun when you see what's going on. And so I slowly bought some silver. I got a lot of silver. So now silver's like over $40. I got to go find all the silver. I can't find it all. So, and I've tried to find it all, and I look forward to selling it at some point, not right away, but I do think that it's going to go up over 50, and then people might start paying attention at that point. But silver is lagging way behind, and the silver people talk about it in this way that I don't understand. It's kind of like, when someone's getting like really excited in a different language or something. I don't know what they like about it because we're in this market where you have things like vault higher in price. And I'm like, here to $50 is like 20%. I mean, here to $100, it's like barely more than a double. And like, you can't even find all the stuff. I mean, it's like, I've got so many backyards to go dig around in. I don't know where all this stuff is, but it is fun to go out and find your stash because, I've been buying this stuff for ages. I mean, I just bought it because I think it was cool. That's what people don't understand. Most of the time, you buy something because it's going to go up, it goes down. You buy something because you think it's super interesting and it goes up, and I just think that to me, I'm at a place in life where I'm like, everybody, I'm just watching what you say and what you do, and then I'm making decisions based on what I see. And it seems to me like really easy to make money.
He contends that the true difficulty lies in adjusting to a future with more stringent financial regulations without losing sight of how to survive and prosper in it. Could the launch of FedCoin hasten the devaluation of the dollar as countries look for alternatives? Will silver continue to be a secondary hedge, or will it finally catch up to the momentum of gold? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
In the bust, most assets are going to go down other than treasuries. But so gold will correct. If 4,000 were the high, and it may not be, could just as easily be 4,500, but if 4,000 is a high, you could be back to 3,000 or below in the bust. People want a target in the bust. I go, we don't even know what the high is on the way up. So, but it'll get hit by, 30% or more probably. Silver, if my target on silver is 75, if we correct from 75, that is more volatile, so that could go down, back into the below 30 or back into the 20s. So they're not going to be straight lines. In both cases, I think this is important. In both cases, in the post-bust era, which is 2027 and beyond, I believe you'll see gold probably in the early 2030s, and silver, same time frame, gold to 20,000 and silver to 500. So
the outlook suggests that during a coming bust, nearly all assets except treasuries could fall sharply. If gold peaks around $4,000 to $4,500, it could correct by 30% or more, potentially dropping back near $3,000. But Goldman Sachs says gold could hit $5,000 under scenarios like political threats to Fed independence. Meanwhile, silver, being more volatile, might fall even harder. If it reaches $75, a correction could send it back below $30. These moves won't be in straight lines, but in the long run, especially from 2027 onward, the forecast is extremely bullish. Gold could reach $20,000 and silver around $500 by the early 2030s. David Hunter, a precious metal expert, points out that gold recently broke out of its consolidation range around $3,300 to $3,400, pushing to new highs, with targets now raised to $4,000 and possibly higher. Goldman Sachs warns that gold's price could increase dramatically if the Trump administration's attack on the independence of the U.S. Federal Reserve is successful. They say that would trigger a flight from traditional safe havens, assets people run to when markets get shaky, traditionally, the U.S. dollar. Forecast already predicts gold reaching $3,700 by the end of 2025 and $4,000 by mid-2026. The result of their expectation that central banks will continue their current gold buying spree. On the other hand, silver has been even stronger, up nearly 50% since April compared to gold's 21%. David mentions key drivers include a weaker dollar, falling interest rates, geopolitical tensions, and heavy central bank buying, all reinforced by strong momentum now attracting institutions. The dollar, down from 110 to 97, could drop further toward 82 in steep steps. With the Fed just beginning a rate-cutting cycle that could bring rates near zero over the next 18 months, both gold and silver still have significant room to run despite cautious sentiment in markets. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the article.
absolutely, and I do say gold was in a consolidation from basically April till recently, and it broke out, from 3,300, 3,400, broke out here, and we're at new highs again. I raised my target to 4,000 last year, or not last year, I think a couple letters ago, and I'm not going to be surprised if that proves to be low, more conservative. So I'm very bullish gold here. I'm even more bullish silver. Silver's had a great run. It's up. I just did the numbers yesterday. From April to now, gold is up 21%, I think, and silver's up 49%. So it's quietly, people haven't really noticed, but it's quietly outperforming gold as it does in a bull market. So I think silver has a long ways to go. Gold probably has a good ways to go too. So I think the weaker dollar is certainly part of that story. Lower interest rates is certainly part of that story. You know, global unrest and global uncertainty is certainly part of that story. And the central banks around the world gobbling up gold is certainly a piece of it too. So, and then the final piece, which people always underestimate, is the power of the momentum. You know, it's all of a sudden the institutions are starting to notice gold, even though it's been running for years. You know, because it's got that momentum now, they're starting to say, hey, we have to have a piece of gold in our portfolios. Not at all. I mean, the dollar's fallen from, you know, basically 110 to 97 in a matter of a year, probably, or less. And I think it's my target is 82. That's far below here. It'll happen in some pretty steep steps. So the first step down in, you know, the mid 90s, and then you consolidated here. I think the next step down takes you down through 90, and then the third step down to 82. So I'm not surprised at all. You have to go through consolidations when you have such a big decline. It then goes the other way for a little while. You have to convince some of the people that were jumping on the bandwagon, but not with conviction, that whoops, this thing's going the other way. So I think we've just pretty much gone through that consolidation, and now we're beginning the next leg down, and I think it could happen pretty fast. Well, think about that. I think that tells you the sentiment that's on the street. Everybody's got including yourself just there, everybody's got a foot out the door saying, when do I exit, right? And so what we've had here, we're just beginning an easing cycle. If the Fed is truly just beginning to cut, and that there's going to be many, many cuts between now and the end of next year, where you could see the Fed fund rate go from, you know, 4.25 here down to even zero. They don't know that yet. They have no idea that's what's coming. But if in the next 18 months, that's what you're looking at, you know, and you're early on in that, and you're at a point where it doesn't look like the economy's falling out of bed, gold's got a ways to run. Silver's got a ways to run. The stock market's got a ways to run. And yet everybody's getting nervous here rather than bullish.
A few years ago, David called for a major market melt-up, and has steadily raised his targets as conditions improved. His S&P 500 target has climbed from 6,000 to 8,700, with Nasdaq at 30,000 and Dow at 60,000. He views this as the tail end of a long bull cycle that began in 1982, likely topping out soon, but still with strong upside left. Despite a slowing economy, falling interest rates and steady earnings are fueling gains. Interestingly, retail investors have stayed confident and bought dips, while institutions were more cautious and even bearish, only now starting to turn more aggressive as they see the market's momentum. Let's look back at the interview.
Probably 3 or 4 years ago, because I was calling for this melt up, and you know, I get accused of raising my targets constantly. I go, that's what you do. As the evidence proves it's got more, you know, there's more things saying it should go higher, you raise your target. So, you know, I started out at 6,000, or even before that at 4,000, but I've raised it to, you know, 7,000 and 7,500 and 8,000, now 8,700 on the S&P. And same thing, I've raised my gold target a few times. But it's the case that this thing is a big historic bull market, and you just gotta stay with it. I'm sorry, I lost my train of thought of what you would. Oh, you were talking about the VIX. Several years ago, I said the VIX could go to 10, and that was when it was in the 20s. And I said if we've got, and that was when I thought the market might go to 4,800, 5,000. I still would say that the low on the VIX, I think, is down just below 10. I think that's probably where we're headed again. So everybody gets worried when it gets down at 14, 15. I go, it can keep going, and there's no magic at 10. If it wants to go lower, it's really, it's a trading vehicle. There are times when it the market goes through a swoon and it bounces back up over 30 and maybe over 50. But other than that, I don't use it at all to say this is the top in the market because it can go lower. We are, as I've been saying for a long time, I think we are late in a long cycle, a bull market cycle that started back in 1982. So this is the 43rd year as of August of a bull market cycle that I think is coming to an end. I expect to see, we probably could top out by the end of this year or sooner. But we've got, I raised targets back in April when we had Liberation Day and everybody got bearish. I raised my target to 8,000 on the S&P. From there, in my July investment letter, I raised my target to 8,700 on the S&P, 30,000 on the NASDAQ, 60,000 on the Dow, and the Russell 3,400. So I obviously think there's still a lot to go here, even though I think it's going to happen pretty fast. It is late in the game. We've had a long cycle. The economy is slowing. We may, in fact, already be in recession, but at this point, the evidence is not building to something that says I'm calling for a global bust next year, as you know. But the evidence right now allows most investors to see this as a soft landing, and earnings are still intact. So basically, you've got the best of both worlds: slowing economy, what I think are going to be declining interest rates, and earnings still growing. And that's music to the ears of Wall Street. That will get all the skepticism that's built up on Wall Street. They've fought this market since 2022, all the way up. You're starting to see them begin to say, "Hey, I gotta get more aggressive because this thing has legs." People, it's not that institutions go all in or all out. They're probably not very much in cash, but they're more defensively positioned. They have been skeptical towards the market. You're right. The retail investor, surprisingly, when we had that swoon back in April, they stayed in the market pretty much, and said this is a buying opportunity. It was the institutions that jumped on the bear market bandwagon and said, "Oh, we're going lower. We're going a lot lower." Strategists across Wall Street were lowering numbers and talking about 4,000 or 3,000 on the S&P. And it was surprising to see the retail investor stay basically on board and bought down there. Like I said, at the very bottom of the sell-off in April, I raised my targets while everybody else was lowering their targets. So, kudos to the retail investor that they this time were the smart money, and it was the institutions that weren't so smart.
Both gold and silver are showing powerful momentum, supported by central bank demand, a weakening dollar, and shifting global policies. While sharp corrections are possible if gold peaks around $4,000 to $4,500 and silver near $75, the long-term outlook remains extremely bullish, with forecasts of historic highs by the early 2030s. At the same time, equities may still have room to climb, even late in the cycle, as falling interest rates and resilient earnings continue to provide fuel. If a sharp correction does occur, would it present a buying opportunity for long-term investors or a warning sign of deeper risks? How much influence will central bank gold buying have in preventing deeper pullbacks in the years ahead? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.
And with physical market liquidity now setting the global gold price, the Fed will have to fold its short derivative hand and as quickly as possible get on board the upcoming gold revaluation. Is at a position where it's got to short cover. And it's going to have to follow what the BIS did. And then figuring that most likely that the December contract, this is spot here, but this contract, which just launched, which was the December contract, and this reflects that COMEX liquidity, is very likely going to have to move in. It'll move into first notice on the 27th of November, and delivery commences on the 28th of November. So this contract doesn't expire until November. So that'll be right around this point here. Well, we suspect that the price is going to be much more reflective of our spot 4,500 target.
With physical market liquidity now driving the global gold price, the Fed has little choice but to abandon its short derivative positions and prepare for the coming gold revaluation. Like the BIS before it, the Fed will be forced to cover its shorts. The attention is now on the December COMEX gold contract, which just launched. Liquidity is expected to shift heavily into this contract as it approaches key dates, first notice on November 27th and deliveries beginning November 28th. While the contract doesn't expire until later, the crucial activity will happen around that period. By then, gold prices are likely to align more closely with the physical market, with projections pointing toward the $4,500 target. Andrew Maguire, a London-based precious metals trader and whistleblower, points out that Chinese pension funds have been directed to raise their gold allocations from just 1% of their $2 trillion assets. At the start of the mandate, gold was around $2,700, but prices have since climbed close to $3,500. Analysts expect this shift could add 1,000 tons of new demand by 2026, nearly a third of annual global supply. India may follow, with regulators considering allowing its $177 billion pension system to buy gold ETFs, adding further demand. This trend reflects a broader BRICS strategy of moving away from U.S. Treasuries into gold after the BIS reclassified gold as a top-tier liquid asset in 2023. At the same time, unreported central bank gold buying is far higher than official data shows, with liquidity providers estimating hidden demand close to 42,000 tons. This accumulation, alongside de-dollarization and treasury-to-gold swaps, is tightening supply while fueling safe haven flows. The U.S., with its limited and heavily rehypothecated reserves, is falling behind. Analysts argue that rising bond yields could soon force yield curve control, driving even more gold demand. All signals point toward an inevitable forced gold revaluation, with conservative year-end price targets set at $4,500 per ounce. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below.
More Chinese pension funds are being mandated to increase their original 1% of their $2 trillion of assets into gold by the end of 2025. Now, they're definitely, that feedback is very reliable. And at the inception of the mandate, gold was trading at about $2,700, equating to about 8 million ounces at the time. That was about 250 tons of a 3,000 ton supply. Since this directive, gold's risen by close to $900 an ounce at 3,500. Now, while this timeline has yet to be revealed, now given the current escalating BRICS trade war leading into military escalations, an additional 1,000 tons, or 1/3 of all global supply, could be demanded by the end of 2026. This feedback has been rock solid reliable, and we expect this to be announced at some point. Also, India's market regulator is considering allowing the country's 177 billion pension system to also buy gold ETFs, a move that could drain an additional 17 tons of new demand, just simply a 1% allocation. Now, this follows the Bank of India switching gears, converting US Treasuries into gold directly after the BIS had recategorized FX gold as a first-tier high-quality liquid asset on the 1st of January 2023. and is representative of what is also empirically evident across the entire BRICS sphere. Also, sovereign borrowers swapping out of dollar debt into lower Chinese and Swiss interest rates. Asian and Middle Eastern investors are avoiding exposure to the US. Also, it's filtered through to the Financial Times through Goldman's desk, picking up on some unreported central bank gold purchases. Our liquidity providers have been reporting, they've been reporting this since Russia's assets were frozen in February 2022. I think a lot of people knew that this was happening, but I think what's interesting is that obviously we knew that physical gold buying had significantly accelerated when the Bank of Internationals squared all their remaining 500 tons of gold swaps. If you remember, that was on the 1st of November 2022. And that was just before the BIS revalued gold as a first-tier high-quality liquid asset on the 1st of January 2023. So for reference, net of paper market dilution, when including direct doré bar imports that seemingly disappear into the 42 district Chinese customs districts, which feed into a 678 loco customs matrix. And we've talked about this before. So much is lost through this system. And we figure this is likely military gold that doesn't get reported. Then if we just base that purely on real global supply demand fundamentals, these same liquidity providers now estimate real unreported central bank monetary gold demand, not captured even in Goldman's assessment, is closer to 42,000 tons. This is not yet priced in, but it still marries with our end of year $4,500 target. Now, these swaps of US treasuries for gold cannot be, they're just, obviously the White House knows what's going on and they are following it. And so obviously after the bullish for gold, India, China, Russian SCO's summit, which is only just finished over the weekend, this will have severely ruffled the White House's feathers, driving another round of fresh safe haven gold and critical mineral silver demand at the expense of the dollar. In fact, directly pushing back against. Now, we're going to update more on these extremely bullish developments as they progress. But as the global central bank sovereign institutional de-dollarization, US Treasury to gold conversion process escalates, it's only a matter of time before the long bond yield rises above 5%, which is deemed as the inflection point that would likely trigger yield curve control, flooding the market with cheap money, which will be hedged with global central bank gold buying. With the US lagging global central bank gold buying and with only 8,100 odd tons of empirically rehypothecated US Treasury holdings, everything points to a cash-settled forced gold revaluation. With the LBMA CME now becoming price takers, buying back leased gold reserves will have to be conducted at market. Conservatively, this reaffirms our minimum target of 4,500 by the end of the year.
Andrew Maguire highlights that since January 2023, China, Russia, and other BRICS nations have been aggressively stockpiling physical silver for military, AI, and green energy needs. With the U.S. now classifying silver as a critical mineral, Washington has joined the race, restricting exports and pushing global sellers to hold out for higher physical prices. Technical charts show resistance around $44.27, with large commercial short positions forced to cover. Geopolitically, this has turned into a full-scale resource war. Andrew Maguire mentions that for years, Beijing quietly funneled Western silver into its vaults. But now with U.S. competition and sanctions looming, stealth is no longer needed. The U.S., starting with minimal reserves and a large naked short exposure through FX silver contracts, is vulnerable. Russia and China are well aware of these paper shortfalls and may use them to pressure the U.S., making a physical squeeze on silver supply almost inevitable. Let's recall the interview now.
On the 1st of January 2023, China, Russia, and BRICS nations began stocking up physical silver for military, AI, and green energy applications. Military being a big component of that. However, now that the US has recategorized silver as a critical mineral, what it's done is ignited a race by the US to also stockpile silver, severely limiting the sales of US silver, in turn incentivizing global sellers to hold out for yet undetermined but significantly higher physically determined prices. Shane, here's the monthly target you referred to that we circled in our last episode, which was right here, and the price was way back here. And the end of the month, this is a monthly bar, the end of the month exactly fulfilled the August target. Now, while we expect $52, 53 in fact, or very close to 53, to be secured as the next higher stair step to rally from, along the way, the next immediate target is 44,275. Now, this is a futures chart where we expect a fight here, but very large commercial short stops sit above this pivot. This is where a huge amount of shorts were added, and not all of them have been covered on anywhere close to getting covered on this rally. So you're going to see some resistance and you're going to see a fight, but once it's through, then really it's blue sky. And guess what? Beijing knows exactly where these stops are, here and here. Following Trump's unhelpful confrontational comments today, this is the Wednesday the 3rd, Russia, India, and China are targeting both gold and paper silver for conversion into physical. This fresh retail demand has not yet translated to the retail market, but it will, further tightening up the 5th consecutive 200 million ounce per annum supply shortfall, providing yet another catalyst to easily drive spot silver through all-time highs. With the US now competing to secure tight for supply physical silver, it's going to unsettle the SGE's stealthy 5-year privileged physical concentration position. Now the gloves have come off, and over the last 5 years, the SGE has successfully utilized control of its global position concentration, employing SGE physical to unallocated spot hedging mechanisms, which were structured to enable them to arbitrage the difference while at the same time containing the silver price, as it strategically was flowed into Beijing vaults. Guess where it was coming from? Or out of the West. So geopolitics, trade wars, and a direct frontal attack on competing BRICS nations declared Beijing no longer needs to be stealthy buyers. And with the CME LBMA open interest migrating out of Beijing's unallocated playpen, so they don't need to play this game, they have enough silver, the race to accumulate silver, along with all critical mineral assets, is underway, catching the US severely on the back foot. The US has come out of the gate with almost no silver reserves, which will mean they will heavily sanction or ban US silver exports, almost certainly. However, the Fed has accrued a very large naked short, unallocated Office of the Comptroller listed FX silver position. It's the only place it shows up, which will now come into Russia and Beijing's crosshairs because they know about it too. So they know that that has to be short covered because there is no silver to back those positions up. And technically, FX silver should be deliverable.
Andrew Maguire emphasizes that both gold and silver markets are entering a historic turning point, driven by physical demand, de-dollarization, and escalating geopolitical competition. With central banks, pension funds, and sovereign wealth funds rapidly shifting into precious metals, the paper-based system looks increasingly unsustainable. If current trends hold, a forced revaluation of gold and a physical squeeze in silver may not just be likely but inevitable. How might a forced gold revaluation impact global financial stability and U.S. monetary policy? Could silver's role as both a critical industrial metal and a monetary asset make its supply squeeze even more severe than gold's? Please share your thoughts in the comments section below. We'd be delighted to hear them. Don't forget to subscribe for more videos and give this one a thumbs up if you found it helpful. We appreciate you sharing in our adventure.